So welcome everyone once again. So tonight, the focus is on the financial statements. And thanks to everyone that contributed to the conversation on the exercise from last class. We will do a quick recap on income statement, and then we'll look at specific example of one company, and we'll talk through it. I went through this last week, that an income statement is constructed using this kind of a template. It might have some wordings that are, said slightly differently here and there, but this is the fundamental structure of an income statement. And it's one of the most important financial statements. It shows you on a short term, on an annual basis, how the company is performing. It starts by showing you how much money did the company make. You can allude revenue to like salary, okay, for those that are working for someone, and for those that own a business, that's the money you made from whatever you sold, either product or service. Now, to sell those products, you have to have bought them. Let's just use that as an example. What is the cost of buying those products? That's the next line. And like I was explaining to Ross last week, the cost of the product, which is also called the COGS, cost of goods sold, is not just the material you buy, especially if you have to do something. Let's say you're not even manufacturing. Whoever, after you buy the product, somebody have to help you shelve it, put it on the shelf, you pay the people. Even if it's yourself, you calculate your cost of labor. That's what they call cost accounting. The cost of your labor should be reflected in the cost of the product, So that's the direct labor that is can be directly linked to getting that product to the point of sale, to the point that it can be sold. That is the direct labor. And then there are some production related overhead. The cost of the electricity that you use to run the machine to turn the raw materials to a finished product has to be assigned as part of the product cost. If not, you have a lot of costs that you have to pay that if you don't correctly allocate, you may not have the correct cost, and you will be losing money when you think you're making money. Okay? All those costs are costs, they say they can be inventory. Labor cost, production overhead rather, is inventoriable. Okay, so if you subtract the cost of the goods from the revenue or the sales, you get the gross. I explained this last week, so I'm just going to quickly browse through it, and then we'll go to a fiscal example. Okay, that gives you the gross profit. And like I said, margin in accounting means percentage. So gross margin is gross profit divided by the revenue, the top line. Then depreciation, which essentially is money that you are accounting-wise allowed to set apart, that is not really leaving your pocket, but you're allowed to set it apart so that you can replace equipment that you use in business, okay? When you subtract your depreciation and your operating expenses, now the difference between operating expense and the cost of goods sold is that operating expenses cannot be directly tied to the cost of producing that material, like the cost of the salary of the CEO of the company, who is not directly working on that product, is working on business development, meeting with government officials, that's not directly tied to the product, right? But somebody still needs to pay for it somewhere. So that's called a period cost. It's an ongoing cost. It's not a product cost. All these people that are in the secretary to the MD or things like that, those are not product costs. If you do advertising, research and development, those are bucketed under what they call sales, general and admin, SG and A. Okay. So those operating expenses, once you subtract those from your gross profit, you come to operating income, the next level of income that you want to look at. So a company should, if a company doesn't have gross profit, obviously they won't even have operating income. So the first thing is, does the company have gross profit? Yes. Okay. How good is the gross profit year over year? Do they have operating income? How good is their operating income? Why is operating income important? It's important because a company could have good gross profit, but they are not managing those period costs efficiently. They are paying their directors a lot of money, and those directors are not really doing much to increase the revenue of the company. So they are not managing those manageable costs efficiently. Maybe the directors are, instead of taking a business class flight to go from the US to London, they go and charter an airplane. Now, that cost is not directly on the product, but it's going to get spread over multiple products, which at the end of the day will impact their profitability. So how effectively a company is managing those SG&A, sales, general and admin, operating type expenses is important, because they might be okay from a gross profit point of view, but because they are not effectively managing their operating expenses, they have poor operating income level. So you're looking at operating income. Is the operating income growing year over year? Is their gross profit growing, but operating income is going down? That should point you to they are not doing something well. Okay, unless you can explain it maybe from depreciation or something like that. Okay, now there might be some other income that is not because of the product or service they sell. Maybe they have some money in the bank, and the bank paid them some interest. That is still an income for the company, right? But it's not part of their regular income. They made it this year, but they may not make it next year. So it's not, part of their regular sales. It has to be recorded as orders, either gain or loss. Okay. And then that when you subtract those from your operating income, you come to what they will be charged interest or taxes on. And that point is what is called earnings before interest and taxes, or EBIT. And then you pay your interest. When you subtract that, it becomes, so the income at that point is called income before tax. And then we subtract the taxes, and you have your income from continuing operations. So this is really the net income that they've made from their normal business. The difference between income from continuing operations and and the net income, rather, I should say, is that there are some other incomes, like let's say the company had a small business that they started and sold during the year. Now, the selling of that is called discontinued operation. Okay, the selling of that company or that business or that arm of their business will generate income. But again, it's not a regular income. It's an income that is only once in a while. Okay, so those are classified as discontinued operation. Some of them might be classified under other income, depending on what exactly we're talking about. Sometimes you see this line called extraordinary items. When they can't find anywhere else to put anything, they call it extraordinary. Now be careful with that. Always check income statements. When the extraordinary income is high, you want to understand why it is high. Now, high is relative, right? For a company like Walmart, high might mean 2 billion. Whereas for a company like, let's say, Domino's, high might be 100 million. Okay, so it's relative, and then you need to be checking what percentage is that versus their revenue. Okay, and then when you subtract all of those, sometimes there's also accounting changes. Let's say there is things like inflation effect, or the currency, if they trade across different countries. Currency values and changing from one currency to the other might affect the accounting. Those also need to be, it could be positive, it could be negative, reflected. Okay. And by the time you subtract those non-regular kind of expenses in your income, you get your net income. These last three numbers should be low unless something significant happened in the company in the course of that reporting year. Okay, so that is the general structure of an income statement. Okay, any question on that before we look at a real example? Right. I want the class to be interactive, so please feel free to ask questions. The question in your mind, I'm almost sure somebody else is thinking the same thing. So please bring it up. Don't hesitate to do so. Just raise your hand like we always do, and let's talk about it together. So this is an example. Which company is this? This is actually NCLH. I mean, we can continue with NCLH, or let's look at Lowe's actually, just so we look at another company. Okay, so this is Lowe's. I think we all know the company called Lowe's. Yes, bro Williams, go ahead with your question.
Yes, I was going to ask, in the course of discussion, you said those stop that we look at, you can set a stop, for the minimum. Are we going to get there in the course of this class, how to do that?
Yes, that's under technical analysis.
Okay.
Yes,
Thank
we
you.
will get to it. Yeah, the actual tool inside your investing or brokerage account might vary. The actual tool might vary slightly, but the principle is the same. If you're willing, we can look at individual accounts together. If not, I'll just show you in principle, and then you'll need to look at your investment account and see how to do it. But it's pretty straightforward. Well, the beauty of that is you can lock in profits. Again, this is part of risk management when it comes to investing. Because we can't afford to be absolute in our thoughts. Yes, we expect the stock to do well. We expect the market to do well. The overall performance is 10%. But if you've made enough profit, and knowing that the market might still go up and down, you want to at least protect your downside from a big negative swing.
Yeah.
But that's why you've made some profit, right? Like we used the example of Norwegian Cruise Line. You've already made, you invested 6,000, you made 4,000, so your total is now 10,000. But the value is currently at, let's say, 12,000. I mean, yes, the potential is that it could go up, but it could also come down if there's something negatively happening in the market. So at that time, I'll lock in my profit. And if it goes up, I go up. If it doesn't, I keep my money and move on. Does that make sense? So,
yes.
yeah, we will look at that in very close detail when we do technical analysis. I want to explain stops and resistance much more closely, especially for the advantage of those in the class for the first time. And then individually, we can also walk and look at your account together, show you how to set stops and things like that. All right, so this is an income statement for a company called Lowe's. I think we all know Lowe's. There are two popular home improvement companies in the US, most popular. One is Lowe's, the other is Home Depot. Lowe's is the one we're looking at right now. The principle is the same as we have talked about. We want to look at income statement. So like I showed you on that PowerPoint a minute ago, the first line is revenue or sales. Who can remind me from previous classes, what is the meaning of TTM? I'm putting you on the spot, but what's the meaning of TTM?
Trailing 12 months.
Thank you very much, Big Mommy. What does it mean? I mean, explain it.
The last 12 months of the looking at the financials from the past 12 months. So for example, this is April. This would be from April 2020 to April 2021.
Thank you. Thank you very much. So it's a moving target. That's why I always say it's not the one you will use for analysis, but you want to look at it to see if there's any major change in the company's performance. It's the last 12 months, looking back from today and looking behind for the last 12 months is what the trailing 12-month numbers shows us. So tomorrow it will be the same 12 months, but plus 1 day, and then 1 day, removed from the last year, and so forth and so on. Thanks very much for explaining that. For the sake of this class, I'm going to kind of focus on the last 4 years financial statement here, 2018 to 2021. All right, so sales similar to what I showed us on the other screen. Let me actually, if I split the screen, it might be a little bit more difficult to see. So let's keep going. Sales minus cost of goods sold gives you gross profit. We all remember that. Okay, so that's the first line item. As a company, we look at the gross profit. 2018, 23 billion, 2019, 23 billion, 2020, 23 billion. So relatively flat gross profit. And then they made 30 billion in 2021. You know that you could almost, I've not gone into to kind of understand why, but I could almost tell you why that is the case. This was for the period that people were at home and they had nothing to do, so they were doing a lot of maintenance on their houses. So they may not necessarily repeat this performance going forward. If they do, that would be a good sign. Okay. So those are the kind of things you want to think about. Why, even when it's a positive change, why such a huge change from 23 billion, which is the average annual gross profit, to 30 billion? That's 7 over 23. That's almost 1/3. That's about 30% increase in gross profit. That, for me, is something that will cause me to think, why did it happen? And I could almost answer it even without reading through any other thing. Now, I think I said this in one of our previous classes, not in this session or in session 2, that when you go to the actual site of the company, they have to, because they are a publicly traded company. So let me look for Lowe's, for example. I don't have their website memorized. So this is Lowe's. Normally there should be a section. I'm not sure if this is their main or this is just for their marketing stuff. Normally there will be a section that talks about investor services. Let me see if I can find that quickly. If not, we'll skip that for today. On the company's website, they are required to post their financials because they are a publicly quoted company. That is an audited financial report. And as you get more into investing, before you invest in a company, especially if it's a sizable investment, you want to actually go in and read the published financial report of the company on their website. That one has to be right. I mean, if not, their directors can go to jail for it. So they make sure that that is done well. Okay. I just want to see if I can find an example. I'm not finding the one for Lowe's. I'm sure it's there, but I didn't look for it before the class. Let's look for Walmart. Walmart, and see if we can find theirs quickly. Official site. Should be at the top here normally somewhere. All right, I'll try and look for it properly next time. I don't want to spend a lot of time. Usually it's very obvious, very easy to see. It will be somewhere on their main page where it will be called investor relations or something like that. And you can go in and check more specifically about the company's performance. Okay, see, here we go. I don't even know which one I clicked. I think I clicked on something that says corporate or something. See, under that, there's this section that says investor. And then there is financial information. They must put this on their website because they're a publicly quoted company. They are owned by you and I that are buying their stock. Okay, so they are required by law to post it. So under financial information, if you click on that, you can actually go in and see their financial reports. You see, on the screen here is annual reports and proxies. Okay, annual report, If I click on that, which is what I just did, 2020 annual report. If I click on that, it actually downloads the PDF. Let's see, the PDF of what was being shown on Yahoo just now. But this is much more detailed. I mean, if you spend the time to read this, you will learn so much about the company. And after we've gone through this class on financial analysis, this kind of statement or report will begin to make more sense to you. Okay, so you can read through it. It shows you their returns, you know, how they are performing year over year, cumulative annual return of a particular investment value. But more importantly, all their financials, including the income statement, which is, you know, the one we're looking at right now, has to be posted in detail. They are not allowed to cover up anything. Somebody was also asking question last week about that. Yahoo might not be perfect. It's not designed to be. It's a quick and dirty way. And I'm using that for this class because it's easily available. You can change things on it and get what you need easily. But this is the income statement. Say, consolidated statement of income for Walmart for 2018, 19, and 30. Sales, you see it at the top. Cost of sales, next, you know, set of items. So sales for last year, 2020, 523 billion, because this number is in millions, see, amount in millions. 523 billion. Cost of sales over the same period, about 394 billion. And then they had SG&A of 108 billion. So your operating income was 20.5 or 21 billion. So 2018, 2019, about 21 billion was Walmart's official financial report. So really, this or the one you download from your investment account is the one you truly should be using for this analysis. If I go in and I pick Walmart out of Yahoo, for example, the numbers may not necessarily be the same because Yahoo is not necessarily an audited financial report. I mean, it gives you a close enough number to use for the analysis, but it's not designed to be perfect. But let's see, this is Walmart I just pulled, right? It says their total revenue for 2020, 2018, and 2019 was 500, 514, and 523. What did we see on their side? Their side said 495, 510, and 523. It's really not that off, right? This is Yahoo, 500, when Walmart say is 495. For 2019, they said they made 510. Yahoo said they made 514. For 2020, they said they made 519. Yahoo said they made 523. This is what I was saying last week. That, you know, Yahoo is not perfect, but it gives you very good 80-20 numbers that you can use for analysis. The cost of goods sold, they said 373, 385, 394. Walmart said it was 373, 385. Actually, it's exactly what Yahoo quoted, plus or minus, that they're also saying their cost of goods sold was. Their operating expenses plus SG&A is also shown here. Yahoo may break it out slightly differently, but 106, 107, 108.
Actually, it looks like the total revenue matches what Yahoo has. You were looking at the net sales.
Oh, yeah. You're right. Thank you for pointing that out. The line I should be looking at is the total revenue because there are some other income mentioned here. So there's the sales, general sales, plus some membership, like, you know, when you go to Sam's Club, you pay for their Sam's Club card, right? That's kind of an income for them too. That's what is under this membership type income. So it's 500, 514, and 523. So let's see, 500, exactly the same. So Yahoo may not necessarily be perfect, but it's good enough. at least for initial evaluation purpose, and also for the purpose of this class, because it's readily available. I can change things and look at numbers, but to look for official numbers, ideally you want to go into the company's website and use the posted annual report. Does everyone understand the point I'm making there? I showed us how to quickly look at it, and it's always posted on the website of every public company. Any question about that? Okay, let's go back to Yahoo. So when I give us the next assignment, what I would like us to do is actually to go to the company's website and use their posted report. If you can't find it, go ahead and use Yahoo, but use the company's posted financial reports. Okay. All right. So from there, we saw the gross profit, the operating expense, which is essentially the same. By the time you subtract all of those, like we said, we come to operating income. And then you have the other deductions that will bring you to the point of the income before tax, earnings before, remember, earnings before income, EBIT, income, earnings before interest and taxes. In accounting, earnings is the same thing as income, okay, net income or income. Because when you hear the word earnings, think of income. Okay, so they then put some money aside for tax, they pay their interest, and they have their net income at the bottom. So for those 3 years, their net income was 9.8, 6.7, and 14. Let's see what they post as net income up here. Yeah, 9.8, 6.7, and 14.9. Pretty much same as Yahoo numbers. Okay, so you can easily use Yahoo for the analysis that needs to be done. Then there is income, what they call earnings per share. Part of the things, okay, so before I even go to that, I wanted to kind of remind us of what are we really looking for. Okay, so we looked at the operating income for this company. The operating income is not going down while their net revenue is increasing. So they are doing something to manage their expenses along the line of the fact that they are making more money, they are not spending more, you know. So some companies, as they are making more money, they are spending more, and you can't really truly point out to how effectively they are spending that if it's not on like research and development or something. They might be having reduction in the operating income. Okay, then you look at the net income also. Net income went up from 9 billion or 10 billion. It came down to 7 billion, went up to 15 billion, stayed at 13.5 billion. So generally speaking, their net income is on an upward trend. Like I said, it might go up or down. If we go in and look at their financial reports for 2019, we will be able to identify why did they have such a big drop. We might even be able to pick it up from some of these. There's an other income expense here of 8.4 billion. So this was one of the things that dropped them in 2019. Now, Yahoo will not explain what that is, but if I looked at their financial report closely, it will be explained. It has to be explained in the write-ups that goes with their financial report. Now, this is becoming even more detailed as an investor. And I know that not everybody has the time or even the tendency to do that. But I want you to know that, you know, when you see a big change like this, $8 billion on other income expenses, that might be maybe they paid some interests and things like that, whatever it might be, will be explained in detail in the company's financials. When you read the wordings that goes with it, they have to see here, it says other other gains or losses, same as Yahoo was showing over there. That year, 2019, the loss, see, losses is the one that has nothing, doesn't have the parentheses. If it was a gain, like in this year of 2 billion, there's a parenthesis around it. So they lost 8.4 billion in 2019. And if you, I've not read through these financial statements, but if you read in the body of the financial statement, they will explain why they have such a big swing. Okay. Now, I know again that it might be challenging for most people to dig into that level of detail, but I wanted to point out that those are the kind of things you're looking for. Big swings. We need to be able to understand why, what's going on. Okay, but generally speaking, the overall net income trend is from 10 billion to about 14 billion, which is a good performance. They've grown almost 4 billion over the last 4 years, which is an average of 1 billion a year, without necessarily growing their, they did grow their sales from 500 billion to 560 billion, so that's part of it also. But they must have been managing their expenses well as well. Okay, any question on what to look for on as we're going through this, please raise up your hand. Then one important ratio is what they call the earnings per share. Net income is equals to earning in an accounting terms. Again, like I said, when you hear the word earning, it means income. But when it comes to EPS, it's the net income, because earnings could be earnings before interest and taxes, right? But when we're talking about earnings per share, it's based on the net income. And to calculate that, you divide the net income by the total number of shares the company has in the market, called shares outstanding. So if you look at this company, their net income for this last year, 2020, I think it's 2021, which ended. So the fiscal year is not necessarily the same thing as the calendar year, right? So their fiscal year ended 1/31/2021, end of January this year. Actually, okay, yeah. I don't have the EPS calculated for that. So let's use the one for 2020. The net income is 14.9 billion. If you divide that by the number of shares they have outstanding, which is 2.8 billion, you will get this 5. So 14.8 divided by 2.8 should be somewhere in that range of about 3. About 15 divided by about 5 rather, divided by 3 is around 5. Okay, so this divided by this is what is the earnings per share. The earnings per share itself is not, it's important because it gives you an idea. For me, for every every share that I bought in this company, in the course of the last 1 year that they've been using it to trade, if I invested $50 to buy it, it made $5 for that year, is what this is telling me. So the earnings or the net income associated with every share the company owns is the earnings per share. Okay. That's also important when we're looking at what is called the price to earnings ratio. The price to earnings ratio is the price per share divided by the earnings per share. Now, the price to earnings ratio in itself is not as useful if you don't compare it with that of another company in the same industry, doing similar business. That helps you to gives you an idea of how expensive, in a sense, a share is. If a company's price to earnings ratio is 10, another company's price to earnings ratio is 20. In the same industry, that means for every $10 that I invest here, I will make $1. Whereas for the other company, for me to make $1, I have to invest $20. So in terms of performance, if every other thing is equal, it makes more sense for me to invest in a company that has 10 PE ratio or price to earnings ratio versus another company. They are more efficient in the way they are running their business. So they are making more money for every share that is sold or that they have in the market. Okay, so that's a thought. Keep that in mind, because I'm going to share that template that I showed us at the beginning with us. Those are the kind of things you're jotting down as you're taking decisions. Should I invest in this company or not? If the two companies are diametrically the same, then I will pick a company that has a better or lower EPS versus one that has a higher one, because they are using their funds more efficiently. Okay. All right. There are a couple of other lines here, but there's no need to go through them in detail. It's just some other way of explaining the same thing or talking about the same thing. So don't bother about those. We talked about earnings before interest and taxes. Okay. Once you get to the net income, you have to pay taxes. And some companies will have this above the net income or do it slightly differently, but the general construction is going to be the same. Okay. And then, they also normalized it in this case, but again, don't worry too much about those. I don't want to spend too much time on normalizing the numbers and things like that. But you see the general construct of an income statement, and a couple of key things to question or to think through. Is the revenue growing? If it is, how are they doing on gross profit? How are they doing on operating income? How are they doing on net income? What is the earnings per share? And what is the price to earnings ratio, which is not shown on this screen. Okay. I'm going to share with us as part of this, the template from this class, actually in the slide deck, these ratios table. It's in the slide deck. It's also in the template that I will be sharing with us. It explains some of those things, the gross margin, the operating margin. Where are you looking at it from? Currently, we are looking at income statements, and I've explained each of these items here. The only one that I think I've probably not talked about is EBITDA, earning before interest, depreciation and taxes, depreciation and amortization. Sometimes, the companies, depending on the way they construct their income statement, they might separate EBITDA out as well. Thought process is the same as I've explained to us. So interest coverage, that's an important point actually. The interest coverage is, do they have enough money to cover their interest expense if they borrowed money? Okay. At least the earnings before interest and taxes. Remember, they have not paid interest at that point. If you remember the table, the slide that I showed us originally, EBIT means earnings before they pay their interest and taxes. Earnings before interest and taxes. So we want to see how much coverage do they have, or how much multiples of their interest expense are they covered for. So if a company made $10 million and their interest expense is $5 million, their interest coverage is 10 over 5, which is 2. So by the time they spend, that amount, just about same amount is left in their pocket. If another company has an earnings before interest and taxes of 10 million and they have an interest expense of let's say 10.5 million, they already have more to pay than they are making. They're going to be in trouble. They will have less than 1 as their interest coverage. So interest coverage must be greater than 1. In fact, multiples, a couple of multiples above 1 to be in a good shape. I explained price to earnings ratio earlier on. And ideally, you want to look at the trend of that over time. Okay. We'll do some examples as exercise to make this clearer. Okay. All right, so I'm going to slow down at this point and take questions. I've gone through a lot of material in a short time. So I want to be sure everyone is on the same page with me. So I'm going to go back and display this. Please allow me to switch on the light here. All right, sorry about that. Okay, so any question on what we have covered so far under income statement? I want to see, if not, I'm going to ask a question to be sure that at least we are catching the key information. Okay, I'm going to ask my own question. I run a business, or I'm asking you to invest in a business, as it were, and I show you an income statement, okay? And in that income statement, I quoted the cost of goods sold. And the salary of the MD is included in the cost of goods sold. As someone that understands financial statements or income statement, what question should you ask me? Somebody in class? If nobody is able to answer that, that means you've not gotten the explanation of what I have explained on some of the elements here. Yes, Ajala. You're muted right now, Biodu.
Please, can you repeat the question?
Yeah, so somebody gave you an income statement, and in the income statement, the MD's salary is included as cost of goods sold. What question will you ask that individual that showed you the income statement? Go ahead, Biodu. You're muted if you're speaking.
Oh, okay. I just got your question.
You just wanted a clarity on the question, not that you had the answer.
Yes, sir.
Okay. Who has the answer? Somebody needs to have the answer. I talked about it last week. I talked about it today.
Yeah, I
Shakira.
think other people are raising up their hand.
Shakira?
I would ask, how does the director directly impacts the goods? I think his salary should be under SG&A.
Thank you very much. Thank you very much. It's gladdening to me when I have such responses. That shows you've been listening, and it's even on the same page that I'm displaying right now.
Yeah.
The director's salary, unless it's directly related to the production of the final product, is he on the factory floor? Like you said, you will ask, how is he impacting the final cost? If it's not, it should really be SG&A or as part of the sales general and admin. Excellent. Thanks. Thank you very much. I see a hand raised up. Stadisola.
Yeah, that is the same thing I wanted to say, that the income of the director should not be part of the sold good. It should be part of the operating income instead of cost of goods sold.
Thank you. Part of SG&A rather than
Yes.
folks. Excellent. Good. All right, so let's move on then. Let me ask one more question. How do you calculate EPS? What is EPS and how is it calculated?
Yes.
Yeah, the EPS is the net income divided by the total number of shares.
Thank you very much. Earnings divided by shares, that is earnings per
Yes,
or
earning
divided
per
by
share.
shares. So net income is what is the earnings being referred to here, divided by the number of shares outstanding. And like I always tell us, use the diluted shares when you do that calculation, okay, because it affects the actual performance of the company anyway. Good, thank you. What is price to earnings ratio? Sister Desola, I see your hand up, so that question
Oh,
goes to you.
okay.
What's price to earnings ratio? What does it mean?
Price to earning ratio. Is that the price per share?
Yeah, you are on the right path, but you're
Yes.
not done. Okay, keep going. It's price per share, but what else?
Is it divided by the revenue? I don't know.
Divide by the, look at my screen. I'll help you out.
Okay.
PE ratio, and these are things that I want us to know because you're going to be needing it for your investment analysis, right? It's price to earnings. So anytime you hear the word ratio, they are dividing something by something.
But
So price is on the numerator, earnings is on the denominator. So
okay.
essentially, it's the price for every share or price
Divided by the earning per share.
by the earnings per share. Okay, you know already how to calculate the earnings per share, which is total earnings divided by the
Number of shares.
number of shares.
Number of shares.
And include that actually here, just so let me include it. So I'm not assuming, so EPS equals to net income divided by shares outstanding. Shares outstanding, okay? Or the total number of shares. So that gives you the EPS, and then you simply divide the price per share by that EPS or the earnings per share to get price to earnings ratio.
Okay.
How do we use, who can explain to me, how do we use EPS? What does it imply? I just explained that as I closed out the last explanation earlier on. What does earnings per share really tell us?
I don't know if I'm sure. Just any
Okay,
like
try.
the shares that each person owns in the company.
That is the number of shares, right?
Number of shares.
What is earnings per that share that you hold? For every share you
Okay.
hold.
How much each share costs?
No, it's how much it's making.
How much is
How much
making
is
the
making?
income?
Okay.
Yeah, it's earnings. Remember, earnings means income, right?
Income. Okay.
So actually, you can convert it from earnings per share to say income per share,
Income.
or net income per share. That is what earning is. So for each share that you buy in that company,
Okay.
is the net income that is attributable to that share. And how to calculate it is you divide that, like you see on row 10 here, the net income by the total shares outstanding, right? So the question is, what does it mean? It's along that same line. It shows how much money each share is really making. But I'm trying to, I saw somebody else's hand up that maybe wanted to explain it. I want to, how would you use it is what I'm trying to get at. How would you use that number? Yes, Biadon.
Yes, sir. The lower earnings per share, the lower the earning per share, it helps you to invest in the company. If they have lower earnings per share, you can invest here in the company.
Thank you. You are along the right lines. The only thing you missed to say was that you're comparing it with a similar company, okay? the earnings per share of Walmart is not going to be the same as the earnings per share of Google. There are different companies in different industries, so their earnings performance are not the same. The number of shares they have outstanding are not the same. However, I can compare a Walmart to a Target. See what I'm trying to say? I can compare a Google to like a Facebook. So companies in similar industry are what you're comparing when you're trying to decide or use earnings per share from an investment decision point of view. But you're right in that it shows how effectively they are managing their company. That is, it's costing you less, it's costing them less to make more money versus another company that has a higher earnings per share. Good, thanks, excellent. How did I say you should use PE ratio? I explained that tonight as well. Somebody, how should we use, or what's the significance of PE ratio? How will we use it? Anyone? No one? Okay, I will explain it again. I explained it a little bit earlier on. I explained that the price to earnings ratio should not be used in isolation. Rather, it should be used in comparison between companies, as it were, just like the EPS. If I have a company that has a price to earnings ratio, Bro Williams, you have a question?
No, I was going to respond. I think I became slower before you started. It's supposed to be how efficient a company is run, right? Is it?
Say that again, please.
How efficiently a company is run. It determines that the company is run is efficient.
Yeah, in a sense, yes. So again, you are comparing two companies that you're trying to invest, right? That are in similar industries. So if a company has a price to earning ratio of 10, and another company in a similar industry has a price to earnings ratio of 20, that means company A that has a PE ratio of 10, it costs them $10 to make $1. Whereas the other company in the same industry, it costs them $20 to make $1. So if you're trying to make an investment decision, it gives you an idea of which one should you truly invest in. If you have only $10, if you have only $20 to invest, it's better to invest your $20 in the companies with a PE ratio of 10 than to invest your $20 in a company with a PE ratio of 20. Okay, because the other company will do twice better in the long run with your investment. So that's how you use ratios when it comes to investment decisions. And I'm explaining all this because I want us, I'm going to share this template with us, but the use of it is going to continue over the course of the next couple of weeks. And what I will be looking for us to do as you're doing your analysis now, Charles, I'll come to your question in a minute, is when you put a company name here, you write what you learn about the company. Why am I interested in this company? I say momentum, news, justification, reason for it. Why am I considering investing in this company at this point? Okay. The estimated turnaround from a fall price, I was explaining that a little bit when I was talking about NCLH earlier on. A couple of things that I'd like you to start putting in. One, what is the 52 weeks price range of that company? What is the low and the high? Where do you get that? If you go to the summary page of Yahoo, it is clearly stated their 52-week range for Walmart is 117 to 154. Okay, so that's where you get that range. you type that in there. What you're trying to do is to collect your thoughts so that when it comes to the point of making an investment decision, you have the data in front of you to make a decision. Yes, Charles. Charles,
Yes.
okay.
Yes, sir. You were you were saying you were trying to complete a statement before you said something. You said the price to earning ratio should not be used in isolation, but rather I did not get the remaining part of it, sir, and then you started explaining, sir.
Okay, good. Thanks for stopping me and asking me to go over it again. It should be used in comparison between two or more companies. Okay, so if I tell you that a company's price to earnings ratio is 10, it means absolutely nothing. Unless you are comparing it with another company, or a comparative company in the same industry. And say, okay, this one is 10, whereas this other one is 15, this other one is 30, this other one is 40. So if I need to invest and I have every other thing being equal, the one I would choose is the one that has a lower PE ratio if everything else is equal, if the company is well managed otherwise. Does that help?
Yes, sir, it does. Thank you very much, sir.
Thanks for the question. So one of the things that you will need to start putting here on this sheet is, again, the next set of assignment will build on each other. What is the 4-year net income performance of the company that you're evaluating? Where do I get that from? You go back to your Yahoo, in this case, or you go to the annual report of the company. You can look at the net income performance here. Okay, look at how did they do from a net income point of view. They made money over the last 4 years. So what I'm saying is, on that sheet, this again is to collect your thought. What you will put here is 4/4. That is 4 out of 4 times they had a positive net income. In the example I have on the first line, I said 2/4, and I explained that as last 2 of 4 net income were positive as of the date that I filled this sheet. Okay, what is the 4 years average earnings per share? Okay, 4 years EPS. So again, you can go back to the sheet, to the income statement, and check what the earnings per share. It wasn't calculated here for 2021 because they didn't show the diluted shares. So you can just do the 3 years. Okay, so 3 years earnings per share, just sum all of that and divide by 3, as it were, is what I'm asking. Again, remember what you're trying to do is you're trying to construct a picture of this company. Okay. And then the price to earnings ratio, I talked about PE ratio. Okay, what is their price to earnings? Earnings before interest, taxes, depreciation, and amortization, EBITDA. I explained that earlier on. What I'm asking is it positive or is it negative? Charles, your hands is still up. You still have a question? Okay. And then price to book value. The price per share divided by the book value per share. Now, we all in this class now know how to calculate book value, right? I'm sure we all can calculate book value now. So that's what that is asking for. But also I was going to show, I think it's under the balance sheet section. It actually shows the book value directly. See, the book value is also given you directly here, in which case you don't necessarily need to go through the calculation for book value. Just divide the price per share divided by the book value per share. So you divide this book value by the number of shares outstanding. That will be the book value per share. And your PB ratio will be the price per share divided by the book value per share. Okay, you put that number there. All right, now that I'm on current ratio, let's go to balance sheet. So I will share this with us after the class. I want us to start using it to gather thoughts around analyzing investments. And there will be some exercises that will help us to use this in the course of the next couple of classes. So let's look at balance sheet. Any other question on income statement? Do we understand the importance of income statement and how to find it either on Yahoo or on the company's website? Is that clear?
Yes.
Okay, thank you. All right, the next important financial statement is the balance sheet. Okay, before I show you the balance sheet here, the balance sheet is actually pretty simple in nature, but let's look at the construction. So I'll give us this assignment, but let's kind of start talking about balance sheet. This is the ratio sheet also, but it's going to be in the template that I share with us. I won't spend too much of time. It's going to be an introduction. We'll go into it in detail next week. But I want us to start thinking about certain things and how they all link together as we go through financial statement analysis. There's a simple formula for balance sheet, which states that assets equals to liability plus equity. And the way I explain this is if I bought a house, let's say I go to the market, I'm looking for a house, and I found a house to buy. And they post that the price of that house is $200,000. That is the value of that asset. That is an asset I'm trying to purchase. It has a market value. Okay. Now, if I had 200,000, I can simply give them 200,000, and that house becomes mine. That property becomes mine. And I have no liability. I don't owe anybody apart from paying my taxes. My liability is zero. At that point, if I want to use the balance sheet terminology or formula, asset equals to liability plus shareholders' equity, or liability plus equity. Since I don't owe any money, what is my liability? If I don't owe any money on buying that house, what is my liability?
Nothing.
Zero.
Zero. Liability is zero. I don't owe any money. Therefore, as a owner, my equity in that property is equal to the value of the property. And that can also be seen in this mathematics. That is, asset equals to zero plus shareholders' equity. And if my asset is 200,000, that means my shareholders' equity has to be equal to 200,000. That is, I own the property because I have no debt in it. My shareholders' equity is equal to 200,000. The value I have in that property myself, is 200,000. If I had to go to the bank and I borrowed some money, and the bank said, well, we're not going to borrow you all the money. You need to put some money up front. And what we want you to put up front is 20% of the cost of the asset, which will be $40,000. At that point, what is my liability?
160,000.
Thank you. Because asset must always be equal to liability plus equity. The bank told me to bring an equity of 40,000, and the value of the property is 100,000. Therefore, I have a liability or debt of 160,000. This is the basis of balance sheet. If you understand that, you're almost a balance sheet expert immediately. Now, there are a couple of nuances and things that we'll be looking at next class, to kind of talk into it in more detail. But I want to plant that seed in us tonight, that is the foundation of a balance sheet. Asset equals to liability plus equity. That simple illustration that we use on the property, I think most of us can relate with it because we buy houses and properties. And it's really the basis when you're looking at a company's balance sheet. The assets are the things the company owns. The liability is the money that they borrowed in order to run their business or buy those assets. The difference between the two is their equity. Okay. Sometimes the equity increase, which is not necessarily what you paid for it. That means your shareholders, if your liability is not increasing, then your shareholders' equity is also increasing. Sister Desola, I see your hand up. Sister Desola, you're muted if you.
Okay. I have a question.
Yes.
So, like you explained about buying a house for 200,000, and like if you pay everything, you don't have any liability on it. But if you get a loan, so what of the tax that you have to pay and like the insurance on the house? Is that not part of the liability?
No, your tax is not a liability. From an accounting point of view, it's an operating expense.
Okay.
It's something you have to pay the government. Uncle Sam will not let you go without it, without paying it. But from an accounting point of view, it has no value related to the property. So it's an operating expense. It's not part of your capital expenditure, as it were. Okay? Does that help?
Yeah.
All right. Another terminology I want to pass across to us tonight is what is called the working capital. This is a very important terminology. You've probably had it used by a number of people, but it actually has a definition. Essentially, the difference between your current assets and your current liabilities. Now, in accounting, the word current means 1 year. Doesn't mean current like in this very minute. The word current means 1 year. That is, current assets are assets that are either cash you have at hand or things that you can convert to cash within the next 1 year. Those are current assets. Current liability has the similar definition, but it's just that it's a liability. Okay, is debts that are going to come due within the period of the next 1 year. They are current liabilities. So your working capital, which is the difference between your current assets and your current liability, shows how much liquid cash, not necessarily liquid, but close to cash you have to run your business at hand, right? The business that you're running right now. Because some people will need you to pay them what you owe them. You need to pay those that are supplying. You need to pay salaries. You need to pay this and pay that. Current assets, things that is either cash or can easily be converted to cash, can be used to take care of those liabilities that are going to come due within 1 year. But if your current liability is greater than your current assets, that is a problem. You have a negative working capital, or what they call the current ratio is less than 1. Current ratio is equal to current asset divided by current liability. So it uses the same item, but it's just converting it into a ratio. When your current liability is higher than your current asset, the ratio, that is when you divide your asset by the liability, is going to be less than 1. So the current ratio must be greater than 1 for any business at any point in time. So when you're looking at your financial analysis in the assignment or the exercise that I gave us, if I explain this to you, the last question says, what other concern will you have about NCLH? And I said, look at their current ratio. The current ratio for Norwegian Cruise Line was less than 1 when I did the analysis at the time I put the slides together originally. This was not a long time ago. So that means their current assets does not cover their current liabilities. Okay. Now, they might need to quickly go and, if your current asset, let me ask you, if your current asset does not cover your current liabilities, How are you going to cover your current liabilities? How can you cover it? What can you do? Anyone?
Take a loan.
Okay. Take a loan. My wife also is in the class. She said you're going to go IPO, initial public offering, which is something some company does. It's not necessarily a good thing to do, but some company does that to raise capital. Okay, thank you. So working capital is a very important terminology. When you're looking at this evaluation, if a company has a negative working capital, don't invest in them. One of the things I saw in Hertz last year was that, and I was becoming concerned about Hertz. You know, their current liabilities was much higher than their current assets. Unfortunately, they were hit by COVID. They were hoping to kind of make do in the short term, but then COVID hit and people were not able to rent their vehicles, so they got even more deeper into problem because they didn't have enough working capital and they had to go bankrupt. And as I showed us earlier on, they are no longer quoted on the stock exchange right now, at least on the major stock exchange. Looks like they are quoted in what they call OTC, over-the-counter markets, but not on the major stock exchange. And every one of us can calculate book value now. I think beyond calculating it, I want you to internalize it. Okay. The book value is the total asset less the total liabilities. And also we subtract intangibles such as goodwill and copyrights and patents and things like that. That's what the book value. What we're trying to calculate with book value or intrinsic value is what is the true asset that the company really has, true real physical asset that the company really has. Okay, that's book value. Okay. All right. Liabilities are very important. The obligations that companies need, and I explain this to people. Liabilities are not necessarily bad. In fact, if a company is using only their own money to run business, don't invest in them unless they really have a good reason for doing so. There are some companies that do, companies like Apple. They are so cash strong, cash positive that they really have no business, borrowing. But other than that case, it actually is not a bad thing to borrow money to do business. And the best way for me to explain this is there's what they call leverage. If I buy an item for $100 and I sell it for $120, what is my profit margin? Somebody. $20. Thank you. So that is my gross profit. Let me make the calculation easier. I bought something for $80. No, let me leave it as it was. I bought it for $100 and sold it for $120. My wife said it's $20 profits. So that's their gross profit. What's the gross margin? Anyone? What's the gross margin? How do you calculate gross margin?
Gross margin is the income, right?
Gross margin is the gross profit divided by the revenue.
Thank you. Thank you. Gross profit divided by the revenue. So in this case, the gross profit is how much? $20 on the revenue of 120. So it's 1/6. I wanted to make the mathematics simpler. Okay. So 1/6, which is what? About 17%, something like that. Now, if I use my own money to do that investment, I made 17% return on capital or return on investment. What if I had the opportunity of buying 10 items at the same price and selling them at the same price of 120? If I use only my money, I can only buy one, correct?
Mm-hmm.
That's all I can buy. And my margin is going to be 17%. But if I borrowed money, I came to you and I said, look, somebody is selling this item for $100 and I want to buy 10. Can you loan me some money? I borrow from you, you loan to me, you lend to me. And I then invest and buy 10 items. But to be able to buy 10, what is going to be my total cost? Thank you. 1,000. My wife just said in the room, 1,000, because each item costs $100 and there are 10 of them, so the cost is $1,000.
Yes.
So I can now invest 1,000, but I'm not going to make only $20 this time around. I'm going to make 20 times 10, which is $200.
Right.
I'm making $200. My margin gross at that point, based on the total amount invested, looks like it's the same. However, actually, I've made $200 when all I have is $100, whereas I will only have made $20. So I made $180 more. But there's a cost of capital. Okay? Whoever loaned me that money, right? Whoever lent that money to me is not a Santa Claus, so he's going to expect me to give him some interest. Okay. So let's say he said his interest rate is 5%. Okay. 10% to make it easier. 10%. So that I need to give him 10% of whatever he loaned to me, which in this case would be how much?
90.
90 each. But on the 10, it will be 900, correct?
Yeah.
Exactly. So 900 is what I borrowed or I loaned, you loaned to me or someone loaned to me. 10% of that is 90.
Mm-hmm.
Okay, so when I return this 900, I have to return 90. Let's say I use it for 1 year. I return 90, so it makes 990 and it leaves me alone. But I still made how much?
110.
Thank you, sir. I still made 110. On my investment of $100, instead of making 20, I now make 110. So what is my gross margin?
No.
110 divided by 1,000.
On
no,
the overall, divided by 210. You see that calculation? Because I'm just looking at my own component of it now, not the money I hold. I borrowed, I loaned. I have only 100. Now I've made 110. So my total revenue is now 210.
Yes, yeah.
And my margin, my profit, gross profit rather, is 110. So my margin, my gross margin is 110 divided by 210, which is what, percentage-wise?
It's
about 40-something percent, right?
Yes, sir.
About 45%.
50,
About
55.
Almost 50, not quite 50. Because
Yeah.
with 50 it was 220. It's about 46, 47%. Let's say 45.
Yeah.
As opposed to 17% if I had used my own money. It's called leverage. Okay, so it's not a bad thing to borrow money when you're using it for business, as long as the return on that investment covers your cost of capital effectively. It's not a bad thing. You make more money for your shareholders when you borrow money. In terms of capital efficiency, you make more money overall than if you are only using your own money. However, if you have enough money that you don't know how to use it effectively, it would be wrong for you to go and borrow money on top of what you have. Okay, so I'm trying to plant a thought in us when we start looking at balance sheets in more closely next week. Those are some of the things that we're looking for. The liabilities. How is the liabilities versus their net income? How are they doing? In terms of their overall use of capital as a company. Okay, so we'll look at that in more detail next week. But to round up for tonight, there is an assignment that will be in the package that I will send for tonight. It is to look at the income statement for a company called Brinker International. Brinker International. I will change this. Let me actually check something out. I think they should have their 2020 financial report already. Yeah, they have their 2020 financial report. So I'll correct that to 2020 instead of 2019. So the assignment is to complete these items for Brinker Inc., also called EAT as their ticker symbol, EAT. What is the company's line of business will be the first question. Does the company have a brand recognition? What's their revenue, sales, gross profit, gross margin, net income, 3 years EPS, stock price, P ratio for the last 3 years, their EBITDA, 4 quarters EPS, 4 quarters analyst expected earnings, shares outstanding, basic and the diluted earnings per share. Then the retained earnings per share, you need to calculate that by based on the earnings per share and assuming that the dividend is $1 per share. Now, if you're not able to get to that, don't worry. I will explain what that means at the beginning of the next class. Okay, I think we can all do all of these now. The only one that I think I may want to explain quickly is where do you get the quarterly EPS? If you go to that same Yahoo page and scroll down, there's this chart here that shows you their quarterly revenue and earnings, okay? And then it also shows you at the top here the earnings per share as numbers. The green is the actual earnings per share. The one that's like unshaded with the blue is the estimated earnings per share. Okay, so all I'm asking is for you to look at this page. You can also calculate it for yourself, as I've explained, but you can simply look at this page on the Yahoo and check their earnings per share for the last 4 quarters. For the purpose of this exercise, that's enough for now. And then the other is for the last 4 quarters, what was the analyst expected earnings? And there's a reason I want you to do that exercise, which I will explain a little bit more next at the beginning of next class. So the one in the light blue without shading is the earnings estimate by analysts. We'll talk about analysts in more detail next class, but look at that, number and put it on your answer sheet, as it were, for the last 4 quarters. Okay, so that's the exercise for next class. Please spend some time to do it. Just write your answer directly on this page, and we'll talk about it like we did today at the beginning of next class. Okay.